see I have some things really focused on. Now, we have the historical hypothetical asset allocation. I talk about all the time with AG 49A, when regulation AG 49A came out, basically what they did is these insurance companies said, okay, the multiplier effect that we were utilizing when we created the multipliers with AG 49, those weren't as effective with the new illustration regulations. So they had to go out and create no cap indexes and proprietary indexes. That's how they were able to get around it and show higher, more inflated illustration. Now, the problem is when you do this, you get away from, here's how I should say this, you get away from the foundational components that Index Universal Life was built on. Now, hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, I'm gonna be doing a breakdown of the Symetra Accumulator product, which is one of the top products being sold by World Financial Group agents right now. I wanna do a breakdown of this product simply because I think there's a lot of smoke and mirrors. Now, there's a lot of pages in this illustration. There's 48 pages in this illustration here. So when we look at this, for the sake of brevity, I don't have time to go through all 48 pages. The purpose of this is not to go through and break down the ledger, because in my opinion, the ledger is a lot of smoke and mirrors. I'm not really too worried about that right now. If you follow my Index Universal Life training playlist, it will break down a lot of the things that I kind of coach people to, and you realize that the ledger on the illustration really just doesn't matter. And so what I think is important is to understand the different moving parts inside of the contract in the illustration. So the purpose of this is it doesn't even matter how I designed or how this illustration was designed. What matters is the fine print in the illustration. And this is what I try to coach people to all the time, is that words matter, and that this illustration is not a contract because it's just an illustration. However, once you take this and if you say, yes, ooh, that's attractive, I want to do this, I want to implement this in my life, the same wording, the same verbiage is going to be on the policy delivery, which is going to be a contract. And so you need to understand all of the verbiage in here is effectively a contract. So this is the Symetra Accumulator policy, which is a big policy sold by World Financial Group. Now, I just pulled out a couple pages that I want to focus on because it's the pages that have the key fine print in them that are really important for people to understand. Now, you can see I have some things really focused on. Now, we have the historical hypothetical asset allocation. I talk about all the time with AG 49A, when regulation AG 49A came out, basically what they did is these insurance companies said, okay, the multiplier effect that we were utilizing when we created the multipliers with AG 49, those weren't as effective with the new illustration regulations. So they had to go out and create no cap indexes and proprietary indexes. That's how they were able to get around it and show higher, more inflated illustration. Now, the problem is when you do this, you get away from, here's how I should say this, you get away from the foundational components that Index Universal Life was built on. Now, a lot of people say, well, they're enhanced, they're evolved, IULs are getting better, the new generation IUL products are better. I'm gonna tell you they're a lot worse because they're actually taking on more risk now, because insurance companies are fighting with regulators and creating other creative ways to make these policies and illustrations illustrate in a competitive way that will make people at least be kind of duped into believing that they're gonna perform in a certain way. But the bottom line is they don't perform in that way. And there's 12 years of history of IULs not performing. Now, I know a lot of people say that Index Universal Life has been around since 1997, and that is true. Transamerica created the first IUL, but the bottom line is until about 2009, IULs had no market share at all. Virtually none. None to speak of. It didn't really matter. It was inconsequential to the market. So when we look at what's going on here, I want to zoom in on, like I said, I want to zoom in on a couple areas that are really, really, really important here. So we're looking at hypothetical stuff here. So I think this is really, really important to read. If you want to pause this, I'll zoom in. You can look at that. You can zoom in on this red area. I'm not going to spend a ton of time up there, but it's really important to understand. Actually, you know what? I'm going to read it just because I can't help myself here. This material has been prepared for informational use and is provided for limited purposes. By receiving and reviewing this material, the recipient acknowledges the following. The recipient acknowledges the following. This material is general communication being provided for informational and educational purposes only. It is not designed to be a recommendation of any specific investment product, strategy, or decision, and is not intended to suggest taking or refraining from any course of action. The material was not prepared and is not intended to address the needs, circumstances, and objectives of any specific institution, plan, or individuals. Putnam is not providing advice in a fiduciary capacity under applicable law in providing this material, which should not be viewed as impartial. Should not be viewed as impartial because it is provided as part of a general marketing and advertising activities of Putnam, which earns fees when the clients select its products and services. Prior to making any financial decisions, any recipients of this material should seek individualized advice from the personal, financial, legal, tax, and other professional advisors that takes into account all their particular facts and circumstances of their situation. Putnam Investments cannot guarantee the accuracy or completeness of any statements or data contained in this material. Putnam Investments cannot guarantee the accuracy or completeness of any statements in this material. This is lingo that gets them out of all the class action lawsuits. Here's the deal. I don't know about Putnam specifically, but what I know is that there are lawsuits with IUL's class action lawsuits and lawsuits happening almost every single month for almost every one of these companies. And what happens is they get settled in arbitration and sealed so nobody can talk about them. If you go look online about IUL class action lawsuits, there are some that make it public. Those are the ones that actually make it to court. So many more are settled and sealed in arbitration. People are settled out, they're paid, but with that, they're basically signed to silence, right? They're basically paid off effectively. And that allows these companies to keep doing this. And this is their protection that no matter what happens with the policies, it just protects them. The material or any proportion hereof may not be reprinted, sold, redistributed, or in whole or part without the express written consent of Putnam Investments. The information provided relates to Putnam Investments and its affiliates, which include Putnam Investment Management. Okay, so that part is what it is. I just thought that, you know, here's the deal. That doesn't speak to any of the really nuanced details of the policy, but what it does is it kind of shows the spirit of the contract, right? Like the spirit of what this is all about and what they're doing. All this languaging is written in such a way that is designed to protect the insurance company and the companies that are running the indexes, right? Like that is a really important component. And this is one of the reasons when I talk about liking whole life insurance instead of IUL, the main reason that I like whole life insurance and not IUL is because when you get into a whole life contract, you are with a participating mutually held company. You are effectively a shareholder of that company. You participate in the profits and the success of that company. So you're like a business partner with them. And so to me, those guarantees and all the risk is on the insurance company. With this, you're basically a profit center to the insurance company, and the insurance company has all the moving parts, which I'm going to get into, that are going to show you that you're taking on all the risk, and they can shift that risk to you at any time. And their ultimate goal, being a public stock company, is to create profits for the shareholders, not for you, the policyholder. Now, I'm not saying here that they're looking to scam you or kind of screw you over, but at the end of the day, if push comes to shove and they have to make decisions about profitability, they're going to look after their shareholders before they look after you, the policyholder. You just become a profit center for the company. And if you can't understand that, just wait. I'm going to show you how they make these things work and why all the moving parts are smoke and mirrors in the illustration. All right, so what do we got here? So let's go. There can be no assurance that an investment strategy based on the Putnam Dynamic Low Volatility Excess Return Index, say that 10 times fast. There can be no assurance that an investment strategy based on the Putnam Dynamic Low Volatility Excess Return Index will be successful. The index does not guarantee future income or protect against loss of principal. Indexes are unmanaged, and one cannot invest directly in an index, right? So this is basically saying this is what it is. You're getting into this thing, and it's not managed, right? You're participating in this index through like I said before, through an options budget and an options cost, right? It all breaks down to that. Those are the two things that ultimately will control the profitability of your IUL, and I'm gonna get into that as we go. This is really, really important to understand here. I've been doing a lot of shorts and a lot of videos talking about the fact that these hypothetical back-tested indexes are dangerous and they don't perform. And a lot of these WFG agents on TikTok came back at me and said, well, of course, everything is back-tested. Well, yeah, it's one thing to take a mutual fund, or it's one thing to take, which I don't believe in either, but it's one thing to look and back test the S&P 500 that has a history of actual performance. It's another thing to do a hypothetical back test. Check this out. The wording is right here. This is why we need to read the contract, folks. Hypothetical back-tested data has many built-in limitations, some of which are described below. Hypothetical backtest performance data and other data, such as hypothetical asset allocations presented, reflects application of the current index methodology and selection of index constituents prepared with the benefit of hindsight. So basically it's saying we were able to cherry pick the index. We were able to cherry pick the stocks and the investments inside of the index, right? No theoretical approach. And so basically they're saying they used theory and they used hypothetical stuff looking back. No theoretical approach can take into account all of the factors in the markets in general and the impacts on the decisions that might have been made during the actual operation of an index. So it's basically saying we cherry picked it, it performed really well, it's gonna illustrate really nicely. This is how they got around Regulation AG 49A when it came out to kind of reduce the performance of these illustrations because they were having so many problems and so many lawsuits. They created Regulation AG 49A. These guys said, we're gonna create these back-tested indexes, or we're gonna create these hypothetical proprietary indexes because we're gonna be able to cherry pick and illustrate it a certain way. And with that, we're gonna be able to illustrate at higher numbers, even though we know that they're not gonna hit these results. This is what's going on, folks, I'm telling you. Simulated performance data is based on criteria applied retroactively with the benefits of hindsight and knowledge of factors that may have positively affected its performance. Hindsight benefits that may have positively affected its performance. Exactly what I just said. And may reflect a bias towards strategies that have performed well in the past. Back-tested performance data and hypothetical asset allocations do not reflect actual performance or actual asset allocations of the index. Actual results may vary, perhaps materially, perhaps significantly. That's the legal word for significantly, materially, from its simulated results presented. Simulated results presented, right? So this is one of those things that you need to, the fine print here is so important to understand. So, all right, so that's that part. Let's go to the next one. All right, what do we got here? So, why index cap and participation rates can fluctuate. Okay, this is really important to understand. I was just getting into this and I knew I was gonna get here, so let's go into more detail. Why index cap and participation rates can fluctuate, right? Index caps and participation rates are primarily affected by Symetra's fixed income investment portfolio yields. What does that mean? That means Symetra, their fixed income portfolio yields, that's their general fund. They have a fixed account that creates an options budget. That fixed account right now is creating about 4%. So if you have $10,000 of income, they're basically of net cash value in your policy, of accumulated value. They're basically gonna say that 4% of that they know is gonna be in the general fund. They're gonna create, let's say, $400 of an options budget. Then they're gonna, so that's, and hedging costs. So then that's basically the cost of options. So they're gonna take that $400 and they're gonna go out and they're gonna buy options. So that's the hedging cost. So as option costs go up, performance go down. This is one of the reasons that the performances of these policies have been so bad over the past 10 years, even during the greatest bull run of all time, because as well as the stock market did, volatility was higher, index competition was higher for a lot of reasons. A lot of it was because there were so many more companies getting into the IUL game. The cost of options based on supply and demand went through the roof. Volatility increases the cost of options as well. And at the same time, the options budget was decreasing because the fixed market was going down. This is where a lot of IUL agents are like, well, the options budget's going to go up because the fixed income investment portfolio is going to improve. Well, that may be true. You know, maybe their fixed portfolio goes to 5%. But the problem is that doesn't solve the problem, because the hedging cost here, the cost of options, when the interest rates go up, what's going to happen is the volatility of the markets goes up, and therefore the cost of options goes up, right? And so that will negate the benefit of this 5% increase. So this is why one of the reasons Bobby Samuelson in Life Product Review right now is talking about the fact, he just wrote a blog post the other day that basically said, even in today's environment, with an increasing environment as far as the fixed rate, he, you know, in the fixed investment portfolio yields, he still thinks that they're going to be either keeping rates flat or reducing cap rates, participation rates, increasing spread charges, all that stuff. It's not a bullish scenario for IULs in this environment. So it's important. Periods of high fixed income. So this is really important. Periods of high fixed income yields and low hedging costs. So it can produce higher declared index cap rates. So that's what you're looking for. You need higher yields and lower hedging costs if you want to see cap rates go up. I'm going to tell you right now, if you believe that we're going to see a world environment where this is going to happen, where that the market is going to be bullish and it's just going to go up, then and that interest rates are going to go up all at the same time, well then, you know what, IULs may be for you. And this is a decision that you just have to make for yourself. My biggest problem, my biggest fight that I have with IUL agents that are like, oh, Chris, you're wrong. And I'm thinking of a couple of people that always leave comments, like Brian, for instance, here. I hope you're watching this, buddy, and you're taking part in this. The problem that I have is that because every IUL, especially no-capped IUL, works like this, is that they need portfolio yields on the fixed basis to go up, and they need hedging costs to reduce. If that's the environment that we live in, you're better off to go just put your money in the market, right? Like because they're sold as this upside potential, downside protection. If the yields go up and the fixed market is improved and there's a low hedging cost, that means the market's probably doing better. That's just the inverse relationship there. The market's doing better. You can just put your money in regular S&P Index 500 funds and get insurance on the side, and you'll be good to go. But the problem is, everybody's being like, oh, 401ks, market volatility, they're trying to like scare you that the market, you know, kind of like the sky is falling, and that you need these things to protect you. But the bottom line is these are going to hurt you even more in the environment that we're coming into compared to what they're telling you. And if they believe this is, I feel like anybody who's selling these doesn't understand what they're selling because they're focused on the wrong things, because they're speaking out of one side of their mouth saying all of this stuff is not going to be happening and that's why you want to buy this. Like they're saying that the market is scary because of the fact that there won't be low hedging, right? Because there's going to be a lot of market volatility, so that means high hedging costs, and they're that, you know, the portfolio, the fixed income market is going to be hard, so there's going to be a struggle to get any yield out of. So they're saying that it's the opposite of both these things, yet these are the things that need to happen for indexes to go up. And so that's why, like, if you're selling these and you're not putting two and two together in that regard, you need to be really, really cautious and careful about what you're selling and make sure you understand these products before you go out and do it. I don't care, people put these hypothetical calculations and simulations together about what these look like. This is the stuff that matters in these policies, because the parts, and I'm going to show you on the next page right here, I think. Yep. So the part that really matters to these products here, I'm going to clear this out so I can rewrite. I did this for a TikTok video. So if we look at this, these are the different options in this product. I have these circled here. It's important to see. So what we have here is the Putnam Dynamic, Low Volatility Excess Return Index. And I know this is green, so my green screen, this is kind of blown out a little bit, so I apologize for that. Not much I can do about that, unfortunately, based on the colors of this illustration. I'm a little limited in my studio here as far as dealing with that. But here's the deal. This is the index participation rate. This is the index floor. This is the index cap. Now you can see here there's no cap, guaranteed and current and guaranteed. So I'll just write here so you can see GTD and CUR for current. And I'll do current GTD. So you can see that the index cap, there's no cap because it's a no cap product, right? So people sell you on the fact that there's this no cap product here with this index option. You got a participation rate of 125%, meaning if the market does 10%, you're gonna get a 12.5% credit in your index, but they have the ability, this is the moving parts that I was talking about on the last disclaimers, and these are the moving parts that control the cap rates, or that control the performance of the policy. Yes, it's performing at 125% right now, but if we go back to this, I'm gonna go back here for a second, if we look at the options cost and the options budget shrinking, then what we have here is they have the ability to reduce this participation rate from 125% right now to 50%. Now, a lot of people go, oh, well, this is a high participation rate, 1 year, no cap. This got 165% current participation rate, and they can't even drop it as much. So on paper, it looks like that'd be the biggest no-brainer. Well, it doesn't matter, because it doesn't matter if it's this no cap, these no caps, this one with a cap rate, or these no caps. They're all dealing with the same options budget and the same options cost. And so the profitability and what the insurance company can actually afford to produce based on the fact that they're giving you an options budget based on their fixed yield account, right? Like, these things are all gonna perform roughly the same way. And all these different moving levers and components to the indexes are really just sales tools designed to kind of, I guess, bait you into a sale effectively. And this is the insurance company's counter to regulation AG 49A. And this is why AG 49B is coming out right now, because they need to counter the insurance company's counter. The regulators are going to counter the insurance company's counter with these. It's total gameplay. And to me, it's kind of BS. We shouldn't even have companies allowed to do this. Hopefully the regulators are able to have a little more foresight and get way ahead of it, because we're coming into regulation 49A and then 49 and then 49A and now 49B. So it's the third time, hopefully third time's a charm, and they can get ahead of it. So let's look through this though, because even if you're not going with this Symetra product, this is the same on every IUL. They all work the same way. And so it's important to understand this product here, the Symetra allocation index options here. Once again, no index floor, no index cap. So there is a guaranteed floor, right? So you can't lose your principal. A lot of people like to say you can't lose money to an investment. You can only lose money to all the other components of it, right? And then the index spread rates. The spread rates mean this is how much money your policy that the index has to earn before crediting is given to your policy. So right now it's 5%. This could be 3%. So anything above 3% in this situation, you're going to start getting crediting with 175% participation rate. Meaning if it goes 5%, that's basically 2% credit with 175% of 2% that's going to go into your policy. But the problem is there's all these moving parts here. So in this situation, I'm just going to talk about this one because it would take too long to do all of them in this scenario. But it's 3%. They can raise it to 20%, meaning the S&P, or not the S&P, the Symetra allocation index options, they can increase the spread rate to 20%, meaning it would have to earn 20% before your policy was credited anything. This is contractual. They have the legal ability to do that. They also have a participation rate of 175%. That 175% can be reduced to 45%. So it's, once again, these moving parts, they will shift and cajole and manipulate these numbers to make sure that the insurance company is not taking on the risk, right? So now you come down here and you look at the good old classic S&P 500 index. They have a current cap rate of 9.5%. That's pretty good. The guarantee, they can reduce this 9.5 to 2.75%. That is the guaranteed component of it. And now they have a guaranteed participation rate of 100%. So this is a little more straightforward, a lot more straightforward, quite frankly, and because the participation rate here cannot be reduced. It is at 100 right now. It is guaranteed to be 100. That is what it is. So the only real moving part in this one is the cap rate. And so this is the cleanest. If I were to do this, I would actually utilize this policy because it's your this index, because it's the S&P 500 versus these other hypothetical indexes. You're getting one with history that is clear, and there's less moving parts, less ability to manipulate. But the bottom line is, it is what it is. They're still going to be able to reduce this cap rate all the way down to 2.75. This number right here, 2.75, that used to be 3% for most major companies. So it's a really important thing to understand. You know, that they've actually reduced this recently. So they've kept these cap rates. Instead of reducing this, they've reduced the guaranteed a little bit just to make it, I don't know, a little more competitive right now from a marketing perspective. Now the JP Morgan Efficient 5 Index right here, you can see no cap, no cap, no cap. Current, so no cap, it's a no cap product. Guaranteed, you can't lose your money, so to speak. Right now it's 135% participation rate, but they can drop it. They could basically cut it in half to 67.5%. And now we see the blended S&P 500 index with the JP Morgan ETF Efficient 5. So it's the blended index. And you can see there's a 2-year point to point, right? And it goes, so in 2-year terms, the current participation rate is 85% because it's over a 2-year period. It's a little more stability. They reduce the participation rate, but guess what? They can reduce it all the way to 20% participation rate, meaning if over a 2-year period, it did an average of 20%, that means 20% of that 20% would be 4% total that would be credited to you potentially. That's how they do this, and they do that because if the cost of options goes up, they need to protect themselves because they can't afford to give you what they can't afford. Right now, this one is at 150%, and they can reduce it to 120. So that seems like a much better option between the two. But my point here is, on paper, this seems like a better option than this one. This seems like a better option, or that seems like a better option than this one. Those may seem better than these or that, whatever, but they're all the same. They're all gonna perform the same, and the insurance company is gonna make sure that they all move to protect themselves in a way that will make it ultimately so the long-term crediting of these things, and we're looking at this from a perspective and through the lens that you as the policyholder or you as the agent, you're selling or buying this as a long-term investment alternative, as a tax-free income retirement income vehicle. And so we have to think long-term. So to think, I'm so tired of all these agents being like, hey, Chris, it's performed. I got a client 40% 1 year. Yeah, good for you. Long-term, this is going to do what I'm talking about, and all these variables are baked into it. So once again, we get into hypothetical circumstances. I'm gonna delete these here. So hypothetical circumstances to estimate. So backtesting uses simulated analysis and hypothetical circumstances to estimate how the index may have performed prior to its actual existence. Index performance calculated by backtesting is purely theoretical. So it just goes into what we talked about before. Neither Symetra nor Putnam makes any representation that the index will perform as represented in this illustration. Okay, so those are the components. I could get in, I could show you the numbers, I could show you the analytics, or not the analytics, but like the ledger, so to speak, of the illustration. But the bottom line is, that's all smoke and mirrors. It doesn't really matter. It's the performance. These things are never going to illustrate, or they're never going to perform as illustrated. That's the big reason I started the IUL challenge. And if you don't know what the IUL challenge is, go look it up. But effectively what it is I got a challenge out there where I'll pay an IUL agent $1,000 if they can show me a policy that's 10 years old that was illustrated, and then in-force illustration that has performed better than the original illustration. Nobody's been able to do it, and I've got almost 100,000 views now of videos talking about the IUL challenge. So I'm doing this because I'm really just, I've always kind of been the guy that stuck up for the people who are getting bullied. And what I see, and I know a lot of IUL agents are out there trying to do what's right by people because they don't know what they don't know. So my purpose of doing these is to protect the person who's looking to buy a policy and to also educate people that are just selling these without really understanding what they're selling because they're selling on illustrations. The problem with this insurance industry in general, with whole life and IULs, people are selling on this illustration war, trying to compare illustrative performance from one company to another, from one product to another. But the bottom line is that's not why you buy life insurance. You buy life insurance. If you buy life insurance as an asset, which I'm a massive believer in, by the way, you buy it as a savings alternative, not an investment alternative, because life insurance companies are not great at taking lots of risks and getting massive returns. They're great at preserving the purchasing power of your capital, and that is what you do inside of whole life insurance. In these policies, you go from being a participating mutually held company as effectively a shareholder with that company, participating in the profits of that company and growing with that company and allowing them to manage your money, and you go away from that and you become a profit center for the company. That is my big problem with this. And that is my big problem with IULs. And my biggest problem with IUL agents that say you can sell these as infinite banking is because of the fact you cannot sell this as banking because there is so much risk in here. A lot of people that say infinite banking is simply the ability to build arbitrage into the policy. If that's what you're saying, you don't understand what the banking concept and utilizing your policy as a banking alternative means and leveraging as such to create more security, guarantees, opportunity, and control with your money in your life to achieve your desired results in a more predictable fashion. So that is it. I'm getting off my soapbox. I know this video went a little longer, but I think it was really, really important to make sure we got through all that stuff. Once again, this is the Symetra Accumulator. It's a World Financial Group product. It's also sold in the independent channels. But the bottom line with this product and what I just showed you is that those nuanced fine print details in this policy are the same in every single IUL contract. You have to read the fine print. And when you do, I think you'll think twice about either selling it or buying it. So if you have any questions, comment in the comment section below. I'm sure there's going to be a lot of fun ones. And that's it for now. Have a blessed, inspirational day. We'll see you on the next video. Take care.